Growth never comes without risk. And for RFM Corporation, this quarter put that principle to the test. Revenue surged to almost 5 billion pesos, and net income matched pace at 341 million pesos. Both numbers tell a story of expansion, driven by improving volumes in both consumer and institutional segments. Pricing moves in key product lines helped, sharpening the company's competitive edge. Yet, behind the impressive top and bottom lines, the financial picture reveals a more complex balancing act. Operating cash flow landed at just 115 million pesos, while capital expenditures soared to 194 million pesos. The result, free cash flow turned negative, with an outflow of almost 79 million pesos for the period. For a company prized by income investors for its steady dividends, this is a notable shift. Why the change? Under Joey Concepcion's leadership, RFM isn't just harvesting its mature brands. It's doubling down, channeling capital back into operations and capacity, in line with a philosophy shaped by years of championing entrepreneurship. The cash spent is an investment in growth. However, this strategy brings working capital into focus. Inventories swelled by more than 889 million pesos in just one quarter, a substantial build to 3.05 billion pesos. The message is clear. RFM is preparing to meet robust demand. But the risk is just as clear. If that inventory doesn't move, it becomes idle cash, and investors will be watching closely for progress. Not all signals flash red. Receivables fell sharply, indicating strong collection efforts. Cash from operations improved dramatically from last year's negative outflow. Margins stayed resilient, with gross margin up to 34.8%, and both operating income and operating margin remaining healthy. Despite the investment-heavy stance, RFM kept its commitment to returns, paying 300 million pesos in dividends and declaring the same for the next quarter. But the cash balance declined, affected by spending on inventory, capacity, and shareholder payouts. The coming quarters will bring clarity. If inventory converts to sales and volumes rise, today's cash pressure will look like the necessary cost of growth. If not, questions around cash efficiency will grow louder. For now, RFM offers investors a familiar headline: higher sales, solid earnings, and another dividend, but with a new footnote. This level of growth demands investment, and the payoff must follow.